the biggest bang for your buck is always going to be revolving debt. Paying it down under 20 or 30% of the total available balance is going to get you the most improvement on your score the quickest.
Becoming a homeowner requires out of you a level of responsibility that automatically you start in your whole life making better decisions financially that increase your net worth.
If you are listening to this podcast, do not do save yourself the headache and the trouble. Just pay for it when it says checkout.
Well, welcome to the Beyond Wealth podcast. Amber Brittain, thanks for joining me.
Thanks for having me today.
So you are Everything Mortgage. We met a while ago. You've worked on a few deals with clients that I've had. I was always impressed with how you and your team just have excellent customer service, very on top of the loan process. You even saved us in a few situations. And so when we talk mortgages and getting money to buy a house, there's no better person than I could think of than you.
I appreciate that. Yes, communication's super important to everybody on the team. And honestly, 18 years later, that's what I've built my business on. And it, I think sets us apart from a lot of people in our industry. So it's something we take a lot of pride in. And I'm glad that you feel the effects of that too.
Yeah, it's so interesting as I have people on this podcast and talk about them. Their core values really shine through, of communication, or if, someone's excellence or whatever it is that they built their book of business on.
Yeah.
Like it's almost one of those things that you just eat, breathe, and sleep it.
Yeah.
You don't have to you just communicate it, and it overflows into the people you work with. It overflows into your teams, because you embody that.
Right.
And so I want to talk about, you've been in the industry for a good bit of time.
Yeah.
You know about mortgages.
I was 4 when I started. It's fine.
And you work with Movement now.
Yes.
So talk me through just a little bit about that team culture, kind of what you guys are doing now, kind of, your book of business, everything you're kind of doing this year.
Yeah. So made the change to Movement in November of 21 for a lot of reasons, but the visions and values totally aligned with everything that I had wanted for my business. Our, saying, slogan, whatever, is we exist to love and value people while creating a movement of change in our industries, corporate cultures, and communities. And I feel like everything the company is about is to love and value people. Like, it's not about the money. It's how can we love and value this person if they're going through a hard time, or this employee needs assistance, or whatever like that. So I absolutely love who we are as a company, and it perfectly aligns and, parallels what I wanted for my team. So we are 49% owned by a nonprofit. We build charter schools across the U.S. We've got 7 built now and 4 or 5 more approved to build in very underserved areas of Charlotte. Next one's coming in Atlanta. So moving this way, which is really exciting. I hope to have one in Alabama.
Yeah, that's
soon.
awesome.
Yeah. And so 49% of our profits go back to build churches and hope centers across the world, and charter schools, just really doing a lot of good for, our clients and the people that we serve, but also leaving an impact around the world around us.
That's awesome.
Yeah.
And so talk about your business. You've been in the business for 19 years, you said, and, kind of what do you do as far as average of loans every year, and your team, and kind of what does all that structure look like?
Yeah. So was with Wells Fargo for 6-7 years. Left there, went to Fairway for a short, 8 years after that. So don't move around a lot. I like things to stay the same. But we grew from 2019, we did about 25 million. 2020, we did 52 million. 2021, we did 70 million.
Wow.
A lot of units. We focus on that because the average loan size in Birmingham's a lot smaller,
Yeah.
So last year we did about 110 units, 26 million. So it's been a slow growth, but last year was hard. So
yeah, it is interesting. Last year I think for even real estate was it was down. Supply is low. There's less movement because of rates.
Yeah.
But the people who are good at what they do and who work hard and put effort, everybody's like, oh, scared. But at the end of the day, I'm still doing business. I'm still around. It's the ones who kind of were part-timers or not necessarily like all in and didn't provide that customer service. They're kind of like falling on the wayside. And I think it's been a really good, hard for some people, don't get me wrong. It's still hard for me and you.
Yeah.
But I think it's been a really good
cleansing.
Yeah. Yeah.
We'll call it a cleansing.
Yeah. And then in addition to that, I was talking to, Stuart from Rely Title, Kent Stewart, and he was talking about just how even the slowdown helps us kind of work on some of our systems. When you're doing a book of business that is crazy when it was wide open, when rates were 3%, it can be very difficult to, really stay like,
we had
on
to get
top
back
of
to basics last year.
Yeah.
100%.
And so it allows you to kind of look at systems, look at things that may be gaps or growth things, or stay on top of current programs a little bit better and different things like that. So I want to talk about that customer service thing, and also just this idea of like, the home buying process. When I help people buy the home, it's a very personal decision.
Yeah.
But at a whole new level, when you're looking at someone's personal finances to get them approved for a loan, there is no hiding.
No.
And that is a very vulnerable position to be in. Yeah. Talk me through kind of how you help people walk through those steps, maybe open up the books because you have to see them. And sometimes that's hard,
Well, it is a very vulnerable position. And I think you have to remind yourself of the time that you bought a house. Because even though I do this every day, when I buy a house, I'm like, ooh, this feels really different. Like being the one in the loan process, you know?
Why'd you ask if I spent $100 at Walmart,
It's my Venmo, okay? But you just have to put yourself in the client's shoes and ease them at every point you can, right? So I think that's why we over communicate, because the more that they know what's going on and they know the why behind why we need XYZ pay stub or whatever, it puts them at ease. It's when they go days without hearing from anybody that they start getting worked up and they get anxious. But as long as you're communicating and in a way that they understand, right? So like what an underwriter says a condition on a loan is versus what a borrower understands are not the same. And so I've worked with people in the past that just copy and paste a loan condition and send it to a borrower. And I'm like, no. Like, they don't know what that is. So I think you just have to give them peace of mind and let them know, like, hey, I'm on your team. I'm going to get you to the end in the smoothest, easiest way possible with no surprises at the end. So just giving them that reassurance and communicating throughout the process.
That's so good. And we'll talk about the kind of the nuts and bolts of the loan process, because I think that's helpful for someone to, understand. Like when someone goes to you, there's actually an underwriter who's actually doing the nuts and bolts of like how much money is going where, and they think that's you and it's not,
right.
But let's talk about the pre-approval process, because I have found that not all pre-approvals are equal.
Deep breath. They are not.
They're not.
Equal.
Everybody thinks they can, go to XYZ online and throw in a few numbers and get this piece of paper that says you're approved, when in reality, that piece of paper has less value than maybe your pre-approval. So
100%.
Let's talk about the differences.
Yeah. So there's a pre-qualification and a pre-approval. And a pre-qualification means, hey, you sent me your numbers. I looked at them. They meet the guidelines. Check. A pre-approval means, hey, you sent your numbers. I got your pay stubs. I got your tax returns. I got your bank statements. And I feel confident that we can close on this letter that we're giving you to purchase this house. They are not created equal by any stretch of the imagination. And we find ourselves in, rescue situations because of that, right? And so I always say, like, it's so important to have a local lender, and you know that. And in multiple offer situations, a listing agent is going to take an 18-year veteran loan officer, even if it may not be the best offer, if they know that it's going to get to the closing table. And so when we have the online pre-approvals, and sometimes there's more weight given to local lenders, and I'm just going to say sometimes, but so it's important that you partner with somebody that your realtor has a trusted relationship with, and that they know is going to get you to the closing table, and they have confidence in that pre-approval. more than just the paper that it's written on.
Yeah, and I think that's so key because that process of really sitting down and looking at the numbers, looking at the W-2s, looking at where cash has flowed, the lack of cash, like all those different things to create a plan for funding that property versus just, you said you made $92K a year. Well, I need to see a W-2 that says that.
Right.
Because that could be a differential of like, well, you make actually 80, but you have bonuses. So those may fall into a different category that we have to think, because the previous year, your bonuses weren't 12 grand, they were 2.
Right.
How do we discover that? How do we figure that out? So it's so key. And I would agree, finding a local lender is huge because in a multiple offer situation, which we are back into, you know, that local lender, it's not just saying like the highest number. It's the highest number that's going to close.
Right.
And oftentimes you can throw out, you could say, I'll pay $1 million for this property. But if you can't close that $1 million, it's pointless.
Right.
And so having that relationship, working through the nuances, all that kind of stuff. I know you've kind of reached into multiple emergency situations. Tell us a story or two of like the crazy things that like last minute happen, you know?
Well, I'll tell you one of my favorites. It just happened in December of this past year. It was a week after closing. One of my top agents reached out and she was like, hey, she had reached out before closing and she was like, does this sound right? And I'm like, no, that doesn't sound ideal. And then a week after closing, she called back. She was like, same deal. Here's the situation, blah, blah, blah. Well, we ended up closing it in 7 days. And it was a single mom. She had been out of the workforce at rehab for part of the 2-year work history. And the guidelines say you have to show 2 years of work history, but it doesn't say consecutive. So they weren't closing the loan. We know the guideline well enough to go, hey, we'll just show where she worked prior to that. So we got her and her 2 kids in a home by Christmas, got them a Christmas tree, presents, the whole 9 yards, like went out to Facebook and said, hey, this is what I'm wanting to do. If anybody wants to donate. And people just showed up big. So we took her like a Christmas tree and everything.
That's awesome.
It was so good because she had worked so hard to get her life together and get back on track. And she was like, she hadn't bought a Christmas tree because she was like, I didn't know if we were going to close. And just being in limbo with 2 small kids, like it's just, so anyway, that was a huge win. And the other lender said to the agent, well, FHA is FHA, so I want to know how she closed it after the fact. And I'm like, you know your guidelines. We knew this going into it, you know? So those are always fun when you can save the day. Yeah. We closed one a couple weeks ago for a family moving here from Utah. Their stuff was in a trailer a week or 10 days past closing when we showed up. And we got it done for them in less than 2 weeks. But like all of their stuff and classic cars had been shipped to Alabama. And they're in limbo.
They're ready.
Yeah. They're in limbo in a hotel because they couldn't close. So yeah, we've had some emergency situations, and most of the time we can save the day. So those are always fun and rewarding.
And that's so key because, you know the guidelines and there's nuances to those that if you can push and pull and figure it out, someone who has less experience, who doesn't know the guidelines as well, doesn't know the changes that have come, can't do that, that leverage to figure out and make the deal happen.
Yeah.
So it's
you gotta
very
think
key.
outside the box sometimes, you got to get creative. And thankfully, you asked about the team earlier. Emily on my team has been with me 7 years. Nikki's been with me 5, and my processor's been with me 4. So we've built an amazing culture within our team, but also I have like the best of the best. And I know guidelines. Emily really knows guidelines. And so she is my right hand to navigate all those pre-approvals and everything. But that's important. But they also have the same servant's heart that I do, right? So they know how important communication is for our whole team. And they're committed to that same level of communication, which is huge and key when they're going through the process.
Oh, yeah. That's massive.
Yeah.
So let's talk about, and I want to get your opinion on this because I think there is a poor time to, if you're thinking about buying a home, the first conversation you need to have is with a lender,
100%.
Number one.
Yes.
You may disagree with this, which is fine. But I think even if you're like, I'm thinking about buying a home in 2 years. I think you need to have a conversation with a lender. There's not too early to have that conversation. Talk me through why that is.
Well, because there's a discovery process, right? And like so often people need to work on their credit. And let's just say they think they need to go pay all these medical collections off. Well, medical collections aren't taken into account when you're getting a mortgage. So here's the thing. They go pay off that medical collection and it might have been dormant for 3 years. They pay it, it resurfaces, drops their score.
You think you're doing the right thing.
You think you're doing the right thing. And that's what people have told you to do. So getting a plan 2 years out helps navigate those situations so we can make the biggest bang for your buck and show you where to put your money in those 2 years. But also like how often you know this happens, but like how often does the perfect house come available and they're not pre-approved yet, right? So if you know where you are, life might happen. You might have a baby, run out of space and need it in 6 months or a year, and you already know that that's not a problem. So the earlier the better for sure, but I think mainly because you need to know how much you need to be saving for a down payment. You need to have a plan for saving for that down payment. So, you know, a good lender is going to talk to you about your long-term goals and say, okay, well, I had this a couple months ago. They wanted to put 20% down. And I'm like, well, actually, you don't need 20% down. You can do this and buy a lot sooner. So it's easier to navigate those things that as they arise if you have a better plan.
No, 100%. And two, like, say you go to the table and you say what we want or need for the family or what we want to, where we want to be is, you know, $300,000 house, we'll say. And you go to someone and say, well, your income does not justify, it justifies 150.
Yeah.
You can't get a better credit score to get there.
Right.
You literally have to find more income.
Yeah.
And if that's someone else going, you know, the other partner going to work, or if that's you finding a different job with significant more pay,
right?
Like you would have 2 years or however many years it is to pivot and say, okay, well, in the next 2 years, I got to find a different career.
Yeah.
Because what we foresee needing in 2 years is, you know, 4 bedrooms because we already have 2 kids and we, you know, so I think it's just like everyone, you know, when first time home buyers or just buyers in general come to me, I'm like, you know, they want to work with me, help, you know, find a house. I'm like, I love that. Let's talk to a lender first. Like that is, you know, it's so funny that like we can have this conversation after you talk to some of my preferred lenders because that process it's almost like I've thought of it, it's like a financial planner, you know, significant
100%.
Conversation of like saying, you know, it's in a niche part of that, but you know everything about getting you to that goal of owning a home.
Well, and the pre-approval is good for 4 months. So even after that 4-month period is up, because some people will say like, oh, well, I'm going to buy this summer. Well, now's the perfect time to get pre-approved. Or if you want to be in a house before the kids go back to school in August, you need to start that process now. We won't have to re-pull credit or anything, you know, by August. You would be covered at that point. So I think it's important to talk about too, like people's biggest hurdle on doing that early is fear of their credit score dropping. So can we touch on that for a second?
Yeah.
Because I literally have the conversation every single day, and you're allowed to shop for a mortgage and you're allowed to shop with multiple lenders. I wouldn't go out there and let 4 or 5 pull your credit. But, you know, if you're going to get the best deal and you want to let 2 or 3, you have a 30-day window for your credit to get pulled before it's going to impact your score. So I love, you know, Experian.com is free. I send people there if they're not quite ready and they don't want to, you know, do that yet. But we do have a soft pull available that doesn't impact their score. I tell people, hey, I can't do a full-blown pre-approval unless I have the full-blown credit report. But the soft pull is also an option. So there's ways to navigate that and make people feel better, you know, about getting that initial credit pull.
That's so good. Talk me through, so it is kind of an interesting thing. I've always thought it's having credit, good credit, all these things. It's almost this song and dance that you are playing. And like you said, paying off medical bills, everybody thinks, oh, that's what I need to do. And it's actually not. so you really have to know the system.
Yeah.
What are some of those other things of like what people think they need to be doing for good credit, and it's actually opposite or different pivots, like paying off the medical bills?
Yeah, that's a big one. And then, the biggest bang for your buck is always going to be revolving debt. Paying it down under 20 or 30% of the total available balance is going to get you the most improvement on your score the quickest. So, when I look at everything, I'm like, well, like if they don't have revolving debt, like how can we get there? We do have a couple, like a what if simulator and a credit score program that will tell us how to get them there. So we have some tools to help figure that out. But medical collections, the credit cards, opening new debt is hard on some people's credit, but you can do like a secured card. A lot of banks will offer a secured card if you don't have any credit or you have new credit. You could do like $500. They'll take $500 out of your bank account, secure it with that, and then you can start building credit that way. So,
talk me through the revolving debt. Explain that.
In what way?
Just like, is it me basically having a credit card?
Oh,
and
yeah.
then, putting all my monthly expenses on it, and then I pay it off. But there's always like a little bit of money kind of floating in debt on that credit card, but it's always paid off. Is that considered a revolving debt, or is there other forms of that?
Yeah. So it's definitely a credit card. It's not your car payments or anything like that, specifically credit, revolving credit. To answer your question, yes, that would be considered revolving debt. And so because credit card companies report at different times of the month, it's very hard to figure out when you pay it off versus when they report it. So many times borrowers are like, but I pay it off every month. And I'm like, well, it has a $6,000 balance, and so trying to figure out the timing of, okay, well, I'm going to go pay it off so that my score can rebound if we're having credit challenges. It's pretty intense to try to figure that timeline out. I'm just going to say. And we just had that situation a couple months ago, and he's like, well, I've got an $8,000 work trip coming up, and that's my work credit card. And I'm like, okay, but we're trying to buy a house too. You know what I'm saying? So maybe it's you move those funds to, your checking or savings or something else until you get done with the home buying process, because it's almost impossible because everybody reports differently. So
different times, different ways.
Correct. Different times.
And it goes back to, like I said, you're playing this game of trying to figure out, and there's no perfect system, but, I remember my dad actually, when I was, I think it was when I first got my job at 14. I started working at Taco Bell, making like $4.75 an hour, slinging burritos. But, so I opened up an account, and my dad co-signed on that checking account and gave me a $500 credit, basically buffer, so I wouldn't bounce a check. I wouldn't bounce a
so
debit card.
good.
And I used it. When my check wasn't there, but I wanted to buy this thing, I would dip into it. I never went crazy with it. It was only $500, but I would go into that credit line and then pay it off, and go into that credit line, pay it off. And later on down the road, when I asked for a credit card, it was like an automatic yes. And I always had good credit. I had no idea what the blessing that my dad gave me with that early on like credit line and me kind of using it. So it's just kind of happenstance for me. But I realized like not everybody had that opportunity or were taught to do that. And, got a little bit of debt through college, but paid it off. And so then that credit history shows like, yes, they use the credit, but they also pay it off.
Right.
If you have a credit card, but you never use it and you never pay it off, there's no history. And so talk me through, that's credit cards. How do auto loans and all that, do they see that similar, or is that because it's not revolving, it's just a one-time debt creation? Do they look at that differently, or is that history of payment still really helpful to your credit? It's
all about the credit history, I think. So I don't know that there's like a percentage of, installment versus revolving into your total score. But but definitely the credit history is helpful. And also when you pay off those credit cards, not closing them out, because like you were saying, the credit history is what you're going for. So it's better to have 5 credit cards with no balance on them and see that you have, control over that spending, I guess.
Yeah.
But that history is still there because it can drop your score if you close out those revolving accounts. But installment, it's actually just, I don't know that it's as much bang for your buck on the credit score.
Yeah.
But like if it's less than 10 payments left on that car loan, we don't have to count that into your debt, which is a huge thing. So also mortgage history, like 1 30-day late on your credit can deeply impact you, and more than, depending on the loan program, more than a couple in the last 12 to 24 months, and you're not getting a loan. So it's really, really important to keep the mortgage on time forever, obviously.
Yeah.
But yeah, a lot goes into it, and it is a song and dance for sure.
Yeah. I know we're diving deep into credit, but I think it's just essential to understand because we all use it. We got to figure it out. And when people come to you for credit score, they're like, why did it go bad? And you're like, well, this is how. When you have 5 credit lines open, that they're not used. We'll say use 1 for your revolving credit like we talked about. That would be good. But all the 4 are just like, open, but nothing on them. That availability of credit, does that count against you on your debt to income ratio?
It does not.
Okay. But so because you haven't pulled any of that access, it just says you have access to it, but it's not going to hurt your...
It's not.
Okay, gotcha.
But if you close that account, then the credit history goes away. So that could drop your score.
Yeah.
So it's more about the account being open long term and not having, any usage even. It's still revolving that's open, that's
that makes sense.
reporting to credit.
I actually had I had a American Express, I think, or some credit card, but it was with a retailer, which is like, why did I open that? At the time you sign up,
because you got 20% off.
Yeah, you got
course.
20% off or like $100 towards whatever. I needed some shirts, and so I think it was Express, back in the day, and. It was one of those things that I didn't know about closing out credit lines and stuff. And so I just was like, I'm tired of seeing this like in my world of like things I got to manage. So I closed it out and it dinged my credit. Luckily I was good enough and it recovered and all that. But I was like, why did I get a negative for closing out a line of credit?
It's crazy. And like, it's so hard to figure out. And like, we're over here deep diving in it. And I'm like, I hope I'm giving you the right advice. No. But something else that we need to touch on is like your dad did you a huge favor by that, right? Like kids come to us all the time, want to buy their first house out of college, don't have any credit, have then got to go establish credit.
Yeah.
So as a parent, I actually added my daughter as an authorized user on one of our credit cards so she can start building for that very purpose. A lot of times kids are buying condos at college. Parents can go on and co-sign with them, but the kid needs to have their own credit as well. So I would strongly suggest doing that for a lot of parents for younger kids, if they can be trusted, obviously, right? Like if it's not going to get abused, but if you've got responsible kids, then letting them establish that early as an authorized user would help.
Man, that is like... That just the education. I mean, this is broader strokes, but to me, like I'm super passionate about teaching my kids how money works. And my father taught me a decent amount, but the second layer of like how money makes money and how credit works and like the nuances of these credit cards and why you use them. And it's just like I wish there was more of that in school to help that. And then also us as parents who have this information are opening lines of credit, for responsible teens.
Yes.
Well, it's not funny. Everybody deserves a line of credit, but
we were just talking about it this week and on a work trip, and like these coworkers of mine were blown away because I have a daughter and she has, she had a job last summer before she went to Auburn in the fall.
Good for her.
Saved a bunch of money. Still has that little nest egg. She's real particular about spending her money. But throughout the time, like I've taught her the value of $1. Like there's not handouts, but like have very respectful kids because of it. You know, I can remember she was 15. She wanted the newest iPhone. We go to AT&T and I said, she's going to be paying for the taxes on this. And he said, does she have a job? And I said, yeah, she works at Edgar's. And he was like, wow, Mom. And I was like, but how else do you teach them if you don't let them have those little moments to invest in themselves? Like, okay, this is important to you, then you can use it for your money. You know, spring break this year, she wanted to go on a trip. So I was like, okay, well, that can come out of your money, you know? So those little, you don't realize how much of a impact those have in the long-term financial understanding and credit history and all of that stuff that is how you build those foundations when they're kids. So I think that's so important.
Yeah, I've been kind of interested because we do chores around our house with our kiddos, but it's not as structured as I would like it to be at this point. And I'm kind of working on trying to get that. But there's one morning where, you know, they have kind of a morning routine. And I was like, some of these things, you know, you wake up one day and you're like, I help my kids do this, but they could probably do most of this,
right?
You know, but we're
Teach
delayed.
Me your ways, Todd. That's a weakness at my house.
You know, we're like running late or whatever. So you're like, I'll just do it.
Yeah.
And so I was like, you know what? We got plenty of time. I was like, so I wrote a list of just like feed the dog, brush your hair, you know, brush your teeth, all these things. And I said, I'm going downstairs and I'm taking a shower. And when I come back up, I expect this list to be done. And when I came back up, the pride in their faces.
So good.
Of just like, Dad, we did the whole list. And they checked it off. And I was like, man, our kids, as much as sometimes they push back on responsibility, as much as they push back on, no, I don't want to do that chore and stuff, there is a pride and a work ethic and a value you are giving them, building up inside of them, that is going to prepare them for the future.
We have a chore chart magnet, and when our youngest was younger, we would laugh, like he will do anything for a sticker. Like if you just give him a star sticker on his chore chart, but he would come up and ask us, hey, does the trash need to go out? Does this need to happen? And we're like, those stickers are working. But some kids, you know, positive reinforcement just works good. And so I love that, but because it's giving them some ownership and some pride in those little tasks.
Yeah. And in that process, circling back to mortgages, they were like, how are we here talking mortgage? But,
well, it happens.
But it helps. It really is setting your kids up for success of the responsibility.
Yes.
And that I would say credit score and all those things, you know, they're not perfect by any means, but it's one of the only gauges that these companies and these lenders have to gauge your responsibility.
Yes.
Did you do what you said you were going to do? Mm-hmm. Did you pay off the debt that you took on? And so, you know, there are nuances to figure out, but the core level is like, it is frustrating sometimes to deal with, obviously hard to rehab credit sometimes, but essentially it's like, just do what you said you were going to do, be responsible, and, you know, things are going to work out.
Yeah,
so
for sure.
Let's talk about, you know, things are shifting. NAR came out with, you know, shifts in commissions for the real estate side. I think lending is going to make some adaptations, already kind of pivoting. Talk me through kind of the most recent updates. I think this will date itself a little bit because I'm sure by the time it airs, it'll be re-updated, and we're living in this, you know, ever-evolving landscape. But kind of where are we currently with lending and how that's trying to figure out accommodations for commissions being paid out of lending.
Yeah, so Fannie and Freddie just came out last week and said that the buyer's agent commission, if paid by the seller, will not go into the interested party contribution percentages that are allowed. So what does that mean? So on conventional FHA, there is a max seller contribution that they're allowed to pay from 2% to 9%, depending on down payment, program, all the things. And so there was fear when NAR first came out that the 2.5%, 3%, whatever the commission is for that buyer's agent would go into that. Okay, so why is that a big deal? Well, if a first-time home buyer needs closing cost assistance and they have a total of 6% on FHA to use, and they're getting, 3% or whatever from the buyer's agent commission getting added into that, then that doesn't leave them as much compensation, contribution. So they came out and said it's not going to go into that number. And I saw it all over Facebook, and it was like, and I'm like, nothing changed. Literally nothing changed. It's the same as it was. You know, they just confirmed, because there was a lot of fear around that. But nothing changed as far as that goes. And I do think some more will come out. I honestly think, personal opinion, that everybody jumped way too quickly. Like, it's not supposed to be implemented until July. Like, I think there's going to be more changes between now and July when it finally gets signed off on and put into action. So I think it's just so important now more than ever that we, communicate our value as a buyer's agent. Like, y'all are so much more than a door opener, and so NAR in itself, I think, is just going to continue to change. But Fannie and Freddie have said business as usual. We're not going to count it into the total contributions.
Yeah, and that's so good to know. There's going to be pivots. I think there's going to be a little bit of a shakeup in a good way, honestly. And in 6 months to a year, we'll probably have what is the new landscape with modified rules and all that kind of stuff. But people ultimately, I think two things. The best I've heard it explained, if someone says they know what's going to happen, they're just lying, because we're
all navigating it together.
Yeah, it's all pivoting.
Yeah.
But two things I think of: the free market will take care of itself.
Yes.
It will figure itself out, and the agents and the people who provide value and take care of people will do fine, and the people who do not take care of people,
there will be a cleansing. There will be a cleansing on the other side.
Yeah, you'll just have to be good at your job, ultimately. And then the second thing I think about is ultimately, like, people say it's going to pivot pricing and all that kind of stuff. And once again, that will get figured out, because people cannot work for free.
Right.
And so when we provide services to people, we have to be compensated. And so I think it all work itself out. There may be some bumpy roads along the way.
Well,
but,
and we went through it with LO Commission in 08 or 09. And I remember the fear, right? So we're like, oh gosh, we're never going to do another loan, and here we are.
Yeah.
We're still doing loans, and everybody's forgotten about that, So I understand, like, from an agent perspective, what that fear of, like, oh gosh, is this changing? How's it going to change? Because I've been through it myself with LO Comp. So, but I also think that if you're not offering a buyer's agent commission, that your listing's going to sit. Mm. That's my personal opinion. Like, I think they're going to have to offer some type of compensation.
Yeah, I don't disagree. And I think the ones who, it's like, go back to the free market, ultimately, there's going to be different pivots. I think it just provides, which there were those options before. I think it was just less understood, maybe.
Yeah.
But there's just a little bit going to be more variety of options of how to sell your home come out. And, it'll give maybe, because when I bought my home, I had a great agent, and they definitely helped me in, like, some of the nuances. But I was the one crawling in crawl spaces to see if the foundation was good, because I'm just kind of a hands-on kind of guy.
Yeah.
But that's my personality. Right. That's what I like to do. So,
but that's also a value that you add as a buyer's agent too, because you are hands-on and you can see issues or potential, things wrong with the house or whatever. So that's a huge value add to have to be hands-on.
Yeah. No, there's several properties I've walked with some of my clients, and I'm like, we're not buying this house. And they're like, and I'm like, listen, the foundation's bad. Like, I can see it a mile away. Come on. We got to go to the next
find another one.
So let's get into, I know it's not necessarily like the super glamorous, but just the basics of the loan process. You got pre-approval, pre-qualification. We don't want to do that. Pre-approvals. So you got your pre-approval. Just talk me through the basic steps, in a nutshell, that process, so a potential buyer can kind of understand what they're walking into.
So we have an initial kind of discovery call that I do with all the clients when the referrals come in, get some nuts and bolts of of their situation, and also discuss long-term financial goals, like what does it mean to you to own a home and that kind of thing, to actually like build rapport, not make it so transactional, make it relationship based. And then we do a client profile online, and then Emily is our buyer specialist, and she runs the numbers, gets them pre-approved, and then calls them to go over payment, rate, closing cost, what she has found for them as far as the programs go. We send the pre-approval letter out to buyer's agent, and then it's time for them to go shopping with y'all. And so then once, they find a house, we like to rerun numbers, get them closing costs and payment on that specific house. Taxes can vary, that sort of thing. And then once they're under contract, we get everything locked in rate-wise, and then submit them to underwriting. Underwriting usually takes a day or two tops, and then we start working on what's called borrower conditions, which means, hey, we're going to lend you $250,000, but we need homeowner's insurance, we need title insurance, we need an extra pay stub or a bank statement. And so we work as a team in getting all of those conditions to the underwriter to then sign off and head to closing. So closing package goes out, and then they close. So
that's awesome. What on some of those like extras they ask for, is that like a lender sometimes specific, or is that sometimes like an actual like government like due diligence? Is it a 50-50? Like where are these like regulations coming from of like, you need to see 5 W-2, statements instead of 4? Like why?
Yeah. I think it is lender specific, but there's definitely government regulations as well, right? So we run loans through an automated underwriting system with Fannie and Freddie directly, and it will tell us in the what we call the findings how many pay stubs, how many W-2s, blah, 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 for that loan program specifically. And then when an underwriter looks at it, let's say there's been a decline in income, and they're like, hey, I need to make sure income has stabilized. So then they might then ask for another pay stub or, a year-end breakdown to see what they made the year before in, like you were saying, bonus earlier. So there's a lot of reasons. There's a lot more conditions around income and assets than anything else, really, for obvious reasons. But bank statements are a big source of conditions. If you are listening to this podcast, do not do Klarna and Afterpay. Save yourself the headache and the trouble. Just pay for it when it says checkout. That's been an increase across the board. Afterpay and Klarna, like, break it up over to 4 payments.
Yeah.
Well, now it's an installment loan as far as your loan goes. So it's, Venmo and all that kind of stuff. So they really dive deep into the bank statements, and there's always something that they need typically with, a transaction question or something.
Yeah. I mean, I will say I understand sometimes people needing to pivot because they want/need certain things. But the way I look at debt personally is like there's a limit, and everybody's place needs to be at a different spot. But if it's below, honestly, like probably about $3,000 or $4,000, I don't take a loan out on it. Like I just do not.
Yeah.
I own my cars.
Yeah.
And that has some limitations with it, and not everybody can do that. I get that. But just personally, I hate car debt. I hate it. Like it is not an asset. It's a depreciating
asset.
Yeah, it's a depreciating, thing. And so I just don't want loans on that. Now that's my personal choice. That's how I've done my investing. That's all that kind of. The only debt I have is on houses. The only debt.
That's awesome.
But all that to say, everybody has to find their own thing. But yes, if you're having to take a loan out to buy a sweatshirt, just maybe you don't need to be buying that sweatshirt.
Yeah.
And those are hard choices. I get it. And everybody's at a different place in their journey of purchasing and discipline with that.
Right.
But when you want to make advancements in your net worth, advancements in your life, you kind of have to grow up. And you kind of have to start making decisions, like an adult. I hate to say it like this, like the podcast, like the real podcast.
Yeah.
But don't be taking debt out on something that's below a certain limit. And I would say that needs to be a pretty significant number, in my opinion.
These are literally for like $150, $200 transactions. It's like they're checking out on Amazon or whatever. I'm just throwing that out there.
Yeah.
And they're choosing these 4 payment options. And I'm like, this it's just not good.
Yeah. So just don't buy.
Yeah.
And save up the money and buy later. If you don't really have the money, and if it flexes or whatever, it's not helpful to your credit.
Right.
Yeah. Credit killers. That's what we need to label this. Like we need to have a podcast called Credit Killers, and like the silent killer. Out there.
Yeah.
But I know we talked a lot about credit, but I think it's so much a part of our lives. And understanding it's a game,
Yes.
and even just money in general, you find the people who are high net worth that I talk to, money is not money. Money is a game to be played. And you see it, the more you have of it and the more assets you have and all that, you see it more like puzzle pieces or like, Monopoly pieces just moving it around. I personally don't see money as a dollar anymore, personally. I see it as a lever to move stuff around.
Yeah.
So the more you can think of it that way, I think even in your first-time home buying process, you can really set yourself up for success.
I saw a graphic on social a couple weeks ago. Maybe you saw it too, but it said like high net worth people, on average, homeowners have, I don't remember if it was 40 or 60% higher net worths than non-homeowners.
Yeah.
Like, wow, that's significant, you know, but that's like the largest piece of the puzzle for most people is in real estate.
Yeah.
In building wealth, and that kind of thing.
Here's a take on that too. Okay. So there's a podcast similar, and he said, becoming a millionaire is less about the money, and it's the person that I must be to become a millionaire. And I would say that true about being a homeowner, because becoming a homeowner requires out of you a level of responsibility that automatically you start in your whole life making better decisions financially that increase your net worth.
Yeah.
Does that make sense?
Yeah, absolutely.
So it's not even now the asset itself. Yes, a home ownership. I'm a huge believer in the equity and the building of that, but it angles your life in a place of like responsibility that you start to think like, I'm frustrated with my boss right now, but I've got a mortgage to pay. Maybe I shouldn't quit today.
Yeah.
Maybe I should stick it out. Long term, no. Maybe I need to pivot careers, but I'm not going to quit today.
Yeah.
I'm not going to quit in one day and then just like move on. Like I've got mouths to feed and I've got a mortgage to pay.
Right.
Like I've got to be more responsible. So then all of a sudden that plays into your net worth, So that's an interesting thought of it puts you in a position that you're making better life decisions.
Yeah,
for
but
the
I think
long
it's
term.
like not to just go down a rabbit hole, but you've also
we're there.
We're there. Siloed killers. But it's important to have your team of advisors too, right?
Yeah.
When you get to that point. You've got your CPA, you've got your financial advisor, you've got, your life insurance and all that kind of stuff. So you have to have, in like being in that millionaire mindset, like once you get to that point, you've got to have a team of advisors to help you navigate that if it's your first time, right? But I do want to touch on first-time home buyers just because there's so much education out there for them. We do several like first-time home buyer classes and that sort of thing. So there's like, just if you are planning on buying a house in the next year, 2 years, 6 months, whatever, like start educating yourself now on what programs are available and 100% programs. And does that make sense, from a building equity perspective? But it's important to start those conversations, like you said, the sooner the better.
That's great. And I love that you said like team. And I would even say a good relationship with a realtor, good relationship with a mortgage, because the mortgage lender like yourself, because this may not be just a single home. You probably are going to buy 2 or 3.
You're right.
And having that consistent relationship of saying
100%.
like, this is my financial team. And like when I purchase something, I go to Amber and talk about that. This has been like eye-opening as far as several different things in the mortgage place. I learned something. Hopefully other people did. I want to circle back one last thing, just maybe a little more personable. because I've always been impressed by you, your excellence, your communication, all that. Just dive into where that comes from. Like, where did you learn it? Where did you catch it? Were you always this way? Like, just what makes you you?
I was not always this way. I know I was raised by a single mom of 3, worked hard, had multiple jobs. So I know the work ethic and the grind and like just the can't stop, won't stop mentality comes from that. You know, like you had a job at 14 and I've just always been a really hard worker. In 2021, we decided to retire my husband and let him stay home with the kids. So failing's not an option. Like I have to get up and hit it hard every single day. But the communication is just going back to that. Like it's how I would want to be treated. And I years ago said, you know, when a customer comes to me, like I want them to feel like I'm part of their family. And that can only be done through the way that you talk to people, the way that you communicate, that they feel like you have their back. And 2017, if we want to talk about, was I always this way? I was not. It was 17 or 19. I can't remember. But an old boss of mine told me if I didn't clean up my acts, like as far as like file quality and like my loan process, he said, I'm not going to have a place for you to work. So I got really intentional in looking deep within and saying, okay, what do I own in this process? It's time to point the finger at me. And I started doing a ton of like podcasts and reading books. I read and do podcasts almost every single day, just trying to get better. You know, I'm coached. I've always paid for coaching. Like, you know, the best of the best coaches. I've actually got 2 coaches right now. So just constantly like sharpening, you know, trying to get better, and learning from others, like being moldable. Like I don't pretend to have it all figured out, but there's people out there doing it better than me, and just opening up and listening to see how I can get better, you know, realtors doing it a certain way or whatever. But then also being open to feedback, you know, like, hey, if I screw up, like, tell me, let's talk through this. Like, how can I get better? Mm-hmm. So just having that always, you know, a student mindset. And so it's definitely transformed over the years.
Man, I love that. And thanks for sharing, because I think sometimes, like, even on my own journey, you know, I didn't start here and I'm still on that journey.
Yeah.
I don't think you ever arrive. But I know that there was a pivotal time in my career where I too, like, kind of was like, I got to wake up and I got to start changing some things about me. It's not about, you know, I need to take more agency, more personal responsibility for the pathway of my life. And it sounds like you went in a similar, you know, direction. Yeah. And I think that's so key, because there's a lot of people who, you know, feel like they can't change, or feel like, you know, the next step is too far away. And it's always encouraging to, you know, hear from someone else who's like, yeah, like you know, life was not horrible, but it also wasn't as good as it could be.
Right.
And I had to take some personal responsibility, make some changes. And circling back to the home buying process, some of this process will test you. Some of this process of figuring out where your finances are is difficult. It's hard to look in the mirror and say, look at all the choices you made, good and bad, and say, this lines up with the type of house you can buy, and it's a reflection of your financial decisions. That's hard. And for some people, it's harder than others. And to have the openness to say, you know what, this is where we're at, but maybe we could improve it, have conversations with great, you know, mortgage lenders like yourself that says, pivot here, and in 6 months, let's have the same conversation.
I never just turn somebody down. I'm like, all right, we're going to put a plan together for you.
Yeah.
And it may be 6 months, it may be 12 months, but seeing them like do the work, do the hard stuff, and then come back ready is so rewarding, you know? And I have this lady in Jasper who was in a bad like apartment situation with a kid. She had bad credit. She had a low loan amount, and like everybody just kept pushing her off. She is literally one of my biggest referral partners because I cared and I took the time to get her credit there. And she's a raving fan, like always sending business, you know, and like everybody deserves an opportunity, right? Like But those are the fun like stories, the rewarding stories. But those are the ones that keep you going and give you light. And you're like, okay, like she helped me, blah blah blah. So anyway, it's just super fun.
No, I love
Something I'm
that.
passionate about.
I love that. And going back to, like you said, home ownership, you know, those people's net worth is significantly more than those who don't. And, you know, yes, this is business for both of us, you know, but we're passionate about it because we believe it changes people's lives.
Right.
It really does set you in a new trajectory. And that's why I love working with first-time home buyers, because it sets their life in a different trajectory than it would be if it wasn't.
Yeah.
And it's more important than ever with low supply currently, high rates. It is a difficult market to buy. I think it's super important to partner with great mortgage lenders, great realtors that are going to help you win in this area and really change your life. So
Yeah.
I appreciate this conversation. It has
So
been
fun.
super, super amazing. How do people get a hold of you if they want to work with you?
Yeah, so you can find me on all socials at Amber Brittain on Instagram, Amber Sykes Brittain on Facebook, and then amber.brittain@movement.com for email. So yeah, let me know if I can help with anything, or even if it's just, you know, strategically planning for down the road, and I would love to help.
Yeah, no, I 100%. If you are even remotely thinking about buying a home, you need to get with a mortgage lender today. Just schedule the call, book the thing, and it'll help craft the trajectory for that eventual purchase. So,
Yeah, so fun.
yeah.
Thanks for having me.
Yeah, thanks for coming on. Time is just super valuable, so I appreciate it.
Yeah.